Welcome everybody. My name is Austin Irving. Here's just a short summary about us for your reading pleasure. My practice is largely general corporate, outside general counsel with a focus on complex transactions. With that comes all sorts of different structures and material terms, but that's largely what I do. Scott, do you want to?
Yes, my name is Scott Newsome. I'm a employee benefits and executive compensation attorney here at Shumaker. I've been doing that over 20 years now. My practice concentrates on leveraging employee benefits to highly compensated employees, owners, key employees, making sure that you get the most bang for your buck in your incentive programs. And in the context of these things, I end up doing a lot of counseling on making sure that owners' objectives are achieved, and also a lot of cleanup when we find things on due diligence. So we will be talking about that.
Yeah. So we're kind of going to go through quickly through the slides, but again, if there are questions, specific questions, happy to answer anything that you have. Obviously when you're selling business, it's the most important or probably the biggest asset that you have, and it's taken a lot of time to grow it there typically, and it's a complex process with considerations that are always factor based. Now more than ever, we see that there are different ways to do things, so there's no set way. It's all negotiation. There's just a few sort of key principles that you see, and then how it varies from those key transaction structures just depends on the transaction. And as a seller, it never hurts to ask. I found that to be a very successful sort of strategy. If someone's determined they want to buy your business, the extra asks, the extra things that are important to you that you ask for never hurts. The worst thing they can say is no. So methods for selling, just to cover that, there are three principal methods. A sale of the company's assets. That's typically what a buyer is looking to do because they'll get a step up in their tax basis. In exchange for that, you might ask for a higher purchase price because you don't get as quality of tax treatment there. A sale of the company's equity, usually simpler, better for the seller, but you may get a lower purchase price because of the lack of beneficial tax treatment for the buyer, and they're buying all the warts of the business, so that may have less value too. And then direct or indirect mergers, a lot of times we see that in roll-ups or more public company deals these days, or community banking. A lot of M&A there is just direct or indirect mergers. Anyway, those are the principal transactions. Again, as I kind of led into, there's really not a best method. It just depends on, largely tax considerations, how long and how difficult it is to move over third-party consents, and deal process and timing. Sometimes the commercial considerations matter. Do you not want material customers to see an interruption in business? You can always buy the name of a company, but if it's literally still just the company, on commercially, say you do a lot of insurance contracts, for instance, or you don't want to have to change an EIN, so we're gonna, you don't want to have to disrupt the flow of income that's coming into the business, and that's typically what guides, what's best for you as the seller and what the buyer is willing to take on too. Those are conversations that take some time as they understand your business and you explain it to them. Assuming the sale is voluntary, there's no time pressures. You have to decide how to market and sell it. You can do it in holding an auction, or you can approach potential buyers individually. We'll talk about investment bankers, but if you already know, and oftentimes people do, potential buyers, competitors, suppliers, distributors, their own management, maybe you want to sell through an ESOP structure, then you don't need to go to third parties to help you sell the business. Sure, you'll have advisors, accounting, legal, maybe some environmental and, consultants, but you don't need to have somebody say, to market your business and pay a fee for that work. Even if it's valuable, a lot of people don't need that. They already know who their buyers or potential buyers are. We see it a lot. Probably a third of our transactions involve an investment banker or broker. It's not to say you need one. And so like we discussed just before, I mean, if you know how to market this and get it to potential buyers, or oftentimes people are approached and they'll solicit letters of intent from potential buyers. You don't need an investment banker, but what investment bankers do ranges. The biggest thing is they help people find potential buyers and create a valuation to take to market. Within that, the responsibilities can vary greatly depending on the engagement letter that you enter into them and the sophistication of the banker. Maybe you only need them to go out and find buyers and value the business. You don't need the other stuff, but the other stuff can be very important working through the process. So sophisticated investment bankers will help with the valuation. They'll get your data room and due diligence in order. They will respond to requests regarding financial statements for the buyer. They will continue to help with banking and consents. They will work through if there's a quality of earnings on the buyer side to ensure that the purchase price we've told them is accurate. They'll help with responses to the quality of earnings. You want to clearly define that role of the investment banker in the engagement letter to hold them accountable to it, because it's really easy, not to knock on investment bankers, for them to find the buyer. They've got their fee locked in, and then all you see is the glow of their cigar for the rest of the transaction. And that's not necessarily what you may need. Fees can be pretty big range depending on the size of the transaction. It's 0.5% to 5%, but largely in that 1% to 3% range. The question is, how we tier that, and you want to restrict some of the guarantees to an investment banker. I'm not a big supporter of upfront fees, but they're in there a lot, where the investment banker says, look, you give me $50,000 to start, for instance, to do it, whether a transaction happens or not. Obviously that'd be credited to the final fee, but I'm not necessarily in love with that. The other thing we would do is we want to tier, the amounts. It should be, usually it's a higher amount in the lower value, but if a transaction's, 25 million, should they be getting the same percentage? Should they be getting that 5% of 25? Probably not. You usually would structure it where it gets smaller the higher the value of the transaction goes, or in tiers. Tail obligations, that's largely what you see sometimes is they get to participate in another transaction. When we get to private equity potential acquisitions, we'll talk about how the sellers end up participating in the ownership of the business post-closing. Well, sometimes investment bankers will say, if you sell again, we get to participate in that transaction as well. I typically strike that and say that there would be a, you'll use, reasonable efforts and in good faith work with them if the opportunity arises. Term is important. You want to be able to terminate, within 30 or 60 days notice. Usually there's a tail obligation, meaning you can't just terminate with them and say that, 2 months later you had that buyer in mind and go ahead and sell to them. They usually want to say, look, we're investing in you to close this deal, similar to a real estate, broker tail agreement. Expenses, usually the seller is going to pay for those expenses. The only question we have is, we don't want them sort of flying around the country on your dime. So we sort of make sure we're careful and clear with what, it's documented, reimbursable, reasonable expenses. And then lastly, when negotiating it, you want them obviously to be confidential with your information. It's a big deal, and you don't want announcements or discussions outside of the sphere of, you know, you're trying to find buyers. Because if the deal doesn't go through, the fact that you're trying to sell can seriously affect, you know, the future of the business. Just talking about processes as you prepare for sale, there's just a couple slides on this. As I said before, equity acquisitions are typically simpler because you're just buying the business as is largely. Mergers are also simpler. Asset acquisitions do require, you know, more formalities because you're picking identified assets and liabilities of the company. You're getting rid of some or all, and just taking enumerated assets and liabilities. There's also consents with that. There's always in every contract, or 90% of them, an anti-assignment clause saying you can't transfer this contract without consent of the other party to it. There often is not a change of control, which is a little more sophisticated transfer restriction, which says, you know, you can't transfer the equity of an entity. So we'll move on. All right, some considerations. These are just a list of things that really are important as you're preparing for sale. How your business works dictates sort of how we treat these things in the transaction. There are many others, but I just put a list of them to discuss here. Work in process is one. If you're a manufacturer or you make things, you know what work in process is. The question is, at a closing of a transaction, how do you get paid for it? What if you've spent, you know, half of your month or half of your 6 months, if you build a big machine that's, you know, a huge investment for you, you've built half of it, there's half to go, but, you know, do you get paid for that half at closing? How do we determine, you know, what that work is? Typically a buyer is reasonable about work in process. They just want to be very clear at the outset as to, you know, how we account for that work in process, how ensuring they get the benefit of what they deserve post-closing. Same thing goes with accounts receivable. A lot of times the buyer is going to want to take those accounts receivable. But as a seller, of course, we want it. We want to have a right to say, you know, as of the date of closing, I'll give you a list of accounts receivable, and those I get to keep. That's work I performed. Those are billings I generated. I deserve that. It's always a point of negotiation. The more leverage we have as a seller, the better the buyer wants your business, the more likely it is that we get a favorable return on those two key points. Again, knowing your customers and suppliers is important from a contractual standpoint. As you're preparing for sale, it can go either way in the sense that if do you have long-term contracts, is that of value? Well, sometimes it is, because a buyer may look at, you know, I've got this government contract or this, you know, evergreen 5 or 10 year agreement. I know I have material revenue coming in for a set period of time. Other times, depending on your business, it's nice to have month to month or only purchase orders, because it makes you more fluid. You can pivot, you can change. Sometimes in sort of franchise context, the buyers love that we can get out of certain agreements, because they say, look, we're gonna cancel it right away and renegotiate with the third parties right after closing, and use that to our advantage because they need us more than we need them. How you approach them, the customers and suppliers, is important. So just understanding what your business relationship is with your customers and suppliers is very important to being able to time consents and, you know, time the business for sale. Accounting, this is one that's changed a lot over the years. Certainly the last 3 to 4 years as you know, transactions have become more popular. GAAP is always the thing that a buyer wants to see. Are you following generally accepted accounting principles? And then they want you to say, yes, we are, except for, enlist a number of exceptions. Do you accrue for vacation? There's lots of exceptions that people may not follow GAAP with. More and more, we're seeing that it really doesn't matter if you're GAAP compliant. We use a definition called seller's accounting principles, which is just the historical, structure of your accounting practices, on a consistent basis. We don't even reference GAAP period throughout agreements anymore, sometimes at least. The idea being they're going to take as much time as they need, or should take as much time as they need, to look at your financials, understand your business, and make a determination, is that good enough? After closing, they can do whatever they want with accounting. They can make it GAAP compliant. They continue operating, but we want buyer to look at the value of your business as it is and determine, is that good enough? Add backs is an important thing on like quality of earnings, determining the value. If we say the business is, worth $10 million, and there are a lot of factors that you're probably familiar with that go into that. Maybe you purchase tickets, or try to think of other things, sponsorships, things that don't need to be reoccurring post-closing for the business to be successful. Maybe you run other things through the business, cars, things like that. Those are actually things that will be added back to the value of the business and make it more valuable. Perhaps you have what some might call excessive compensation, that someone could do your job. I mean, you're all important as business owners, but perhaps you take a salary of $300,000 and you tell the buyer, and they trust you that it only should take, you can find someone to run that function for 150. Well, that 150,000 gets added back to the value of the business as an add back. And then if there's a multiple on your business of 5 to 10 times, we're multiplying 5 times 150 or 5 times 7 or 5 times 10 to add more value to the business. I'll let Scott cover benefits shortly. Environmental just depends on your business. A lot of people don't have environmental issues, but we do see it, 1 out of 10 transactions where there's, something's there because, 20, 30 years ago or 10 years ago, you got a phase 1, or you got a phase 2 because there was some dirty water or shiny earth. How you remediate that is important in the sort of leading up to closing and post-closing. Sometimes you may have to have a situation where you're responsible for the cleanup, or there's escrowed money. We try not to make escrow. We try just to assume, entire responsibility for it, but that's often a consideration. And then the real estate's important. Same thing that we were talking about with knowing your customers and supplier contracts, that goes for real estate too. If you have a lot of leases, are those good to be month to month? Because you can cancel and move, or buyer may want to have a different place or reduce rent overall costs. Sometimes the buyer may want you to go ahead and lock something up for a long term. Do you own the real estate in a separate entity? Do you lease it to the operating company? Maybe we want to go ahead before the sale and enter into a long-term written lease that has defined structure that the buyer will have to assume, as we get to closing. Those are all considerations that we typically walk through and discuss. And a lot of times you as sellers will know what you want. It's just how to get there. I'll pass quickly through this. There are really just 3 general categories of consents. There's your organizational documents. So if you have, maybe there's the family business has 5, 10, any number of family members. Well, those approvals, you have to ensure that you have the requisite approval to approve a transaction. And if you don't have enough approvals, we need to go talk to those people, or get creative in the transaction structure, because oftentimes organizational documents haven't thought about the different ways that we can actually structure a transaction to get around certain consents. So those are just, that's one consideration on the org documents. There's statute and other regulation requirements that are now, at least in Ohio and other states, they leave a lot of that to the corporate governance documents themselves, but there are still minimum approval requirements required. And then, contractual consents, which we talked a lot about. What's in the four corners of each one of your documents that's required to approve a transaction. Very important. Okay, well, this is it's pretty straightforward, but board approvals, if you're a corporation, you may not even, a lot of times you're a sole owner, you still need a board approval technically to approve the transaction. That's a statute driven requirement. Shareholder or member approvals, same type of thing. A statute has a limited amount that's required, but then your own corporate governance documents may dictate something different. And then member and manager approval, it's effectively the shareholder board of a corporation, but in the LLC context, we just need to make sure that those approvals are obtained prior to, and the buyer will always want to see and ensure that those are done properly prior to closing. Just pass over this quickly. Regulatory approvals, we're seeing a lot more antitrust sort of. Now these are larger transactions, typically 100 million or larger, but the antitrust Department of Justice has gotten a lot more attention on sort of anti-competitive sort of dealings. So they've investigated them more. You'd think there was less sort of red tape these days, but there's a lot more. We see it often. And then regulatory authorities, you see in any type of business, if you're a plumber or you have electricians in permitting, that's important because those permits get opened over and over. Who post-closing is going to take over that job? Say you have, I'll use electricians as an example. Usually there's a couple of named persons, key named persons associated with an EIN of a business that are in charge of pulling under their authority permitting. If those people aren't going to be involved with the business post-closing, the buyer and the seller need to work together, and maybe they hold on to your name for a period of time post-closing to ensure that they're not going to lose all those open permits that they have operating in people's houses or operating, in some commercial development. And it's always a negotiation that you may need to get paid for if you're going to let them have your name or your permits or your license for a period of time post-closing. All right, we can certainly pass through this because I've discussed it in detail, but landlord consents and lender consents are always important. The lender consent side is typically, and we'll discuss it more, your buyers are going to try and purchase a business cash-free, debt-free. You get to pull all the cash out prior to closing, subject to potentially a working capital requirement, which we'll talk about. But they're not going to want to take on any debt, subject to a few exceptions that we'll talk about. All right, I'll turn it over to Scott for executive key employee comp, and I'll be back with you shortly.
Hey, thanks, Austin. As Austin alluded to, one of your processes that is going to get a lot of examination are your benefits, your processes, your employees. And sort of the initial question is, obviously most businesses have valued employees that are key to the transaction. Are those individuals going to continue with the company post-transaction? Why? Is there an employment agreement? Is there some compensation or program that makes the business unusually attractive that they're going to stay? And that's some of the value that when you're selling your business, the buyer is going to absolutely want to retain. So we'd like to do, as you work towards potentially marketing your business, a review. What do your current employee agreements look like? What do your incentive programs look like? And how are those going to work in the context of a transaction? Now, a lot of times as people start to look towards marketing their business, they're talking about, what incentive programs do I want to adopt for my key employees to work towards this goal and have them mutually participate in the eventual sale. And the one thing with that is we've seen it a couple of different times where some of our clients have previously adopted incentive programs, like a phantom stock, where an employee might have phantom shares that upon a successful transaction will result in a payment equal to, say, 2% of the outstanding shares. They have phantom shares worth 2% of the company. And it's important to, as you think about adopting incentive programs or current incentive programs, is what's that going to actually look like when the sale closes? We had a client, they had adopted a phantom stock program long before they became our client. And when the transaction ended, they had one long-term employee and she was going to receive a $3 million phantom stock payment. And now the transaction was in the hundreds of millions, but at that point, the owners are looking at this and saying, well, she actually wasn't that key to the growth that took us from what we thought we were going to be selling at to our eventual sale price. So it's important as you develop incentive programs that you look long-term, what's this going to look like if we actually do become wildly successful? Is this person absolutely essential to getting there? If we get there, are their contributions necessary, or are they just a long-term employee? We had another client that actually had a really unique business. They had these employees that were effectively what you'd say are estimators. And a good estimator, all the estimators earned about $50,000, $60,000, but a good estimator could make the company millions of dollars. So they were very valuable. And so what the company did is we talked with them, and they ended up adopting sort of a rolling bonus agreement. So at the end of the year, they looked at the estimator's productivity, how good was the estimator in creating profit for the company, and then they would bonus that employee. And sometimes those employees were getting $50,000, $60,000 on basically doubling their compensation. But those bonuses would not be payable unless that individual stayed with the company for 3, 4, or 5 more years. So you essentially had these very valued employees that had over $200,000 in bonuses coming due in the next 5 years as they sort of built up. That's really hard for your competitors to come in and take that employee away without paying them that money. Once they have that in that queue, they were thinking, I'm going to buy a pool, I've got college, I've got a Disney trip for my family, and they planned around that money. Then when the company sold, the buyer eventually terminated that program, and within 5 to 7 years, all of those people were gone. They paid out all the bonuses, and then they said, well, we don't really think that that's a very effective program. And one by one, those valued employees leave. So it's important that you have systems in place to drive towards your eventual goal. At the same time, understanding who is essential and who's driving the creation of value. Austin, can you switch? So one of the other things that is important in preparing your company for sale are your ongoing benefit plans, your health and welfare plan, your health insurance, your retirement plan. a lot of times people buy these off the shelf from your broker and sort of set it in place and forget about it. And we'll talk with people and they'll say, oh no, mine are fine. And more often than not, you have an operational error in your retirement plan or your health plan. You just don't know about it because you haven't looked hard. And once you get to the transaction phase, those can become an issue, particularly if you're talking about an equity deal where the buyer is buying stock and taking all of the liabilities with the company. They're going to want to see these terminated. But if there are errors and things that need to be corrected, that can delay the eventual transaction and cause a lot of headaches as you try and work towards a desired time of closing. So a lot of times when people are looking to market their business, we'll suggest, hey, let's have a sort of a pre-transaction review of your benefit programs. Let's see what's going on. Basically start the due diligence process on these plans and make sure that everything's, at least if things need to be corrected, we're doing that without the impending closing date where we need to get it done by a certain time. Just to sort of alert you to a few issues that may exist. If you have a retirement plan, most likely you have something that is maintained on a pre-approved document. You got it from your broker, you got it from your investment advisor. It's a Fidelity document, it's a Vanguard document, it's from your Morgan Stanley broker, your Merrill Lynch. Those are all pre-approved documents. If you have a 401k profit sharing plan, you should be restating that pre-approved document. They'll send it to you. You need to do that by July 31st, 2022. So this July, if you haven't received that from the person you get your plan through, I would suggest following up with them. If you have a defined benefit pension plan, a traditional pension plan, or something like a cash balance, that restatement was due 2 years ago, July 31st, 2020. We've seen a number of people due to COVID not have gotten that done. And the fact of the matter is employee benefit corrections are actually very easy to do if you're doing it in sort of a proactive manner. If the IRS or the Department of Labor has audited you and they find it, it can be expensive and take a good amount of time. But if you find it on your own, they have standardized processes and pre-approved correction paths where it's relatively simple and not expensive. Some other common examples, somebody has failed to file the Form 5500. A long-time HR director in your company has left the company. They always took care of it, and somehow that gets lost. When your company goes over 100 people in the plan that participate in the plan, and that just means that they're eligible, it doesn't necessarily mean they're deferring. Your retirement plan then requires an audit by an accountant. Often that causes some issues as people are unaware of that requirement. Lots of other things, on your pre-approved document, it might say all employees are eligible, and by practice you say, well, we don't make it eligible for part-time employees. Well, you need to make sure your operational actions line up with what the actual plan document says. Those are sort of the things that pop up in a transaction and can create some headaches as you're saying, working towards a June 1 closing date, and suddenly you're talking with Vanguard or Merrill Lynch or Morgan Stanley trying to get information so we can terminate the plan and get a correction in prior to closing. Awesome.
Scott, right now you're just highlighting all of the problems we've dealt with in the last major transaction.
Yeah, maybe last 6 months.
Yeah.
It's always the same things.
Yep.
It's constant. And people will say mine is fine. Well, you honestly, you just haven't looked hard enough. There's always some minor error somewhere. Some box wasn't checked on that restatement that, whoever did the restatement didn't line up the boxes right. They checked the wrong box, and suddenly your long-term operational activities no longer line up with what your plan document says.
Right. All right. Well, thanks, Scott. Talking about private equity investment for a little bit, small or large, doesn't matter the size of your business. Private equity is playing in all the different sizes of space these days. It's just the size of the private equity firm may be large or small. One thing is for sure is, and oftentimes they are not operators. They're going to look for a business that has either the owners continuing on or quality management to continue on and operate the business. They will handle the financials and then be looking for another seller or another buyer, down the road. Typically, as I talked about earlier, these transactions are cash free and debt free, meaning you take all the cash prior to closing, and they don't want to take on any of the debt. That's a consideration for you as you say, hey, I've got this $12 million business, and it may very well be worth that. But if you have huge lines of credit out there, or you borrowed for equipment purchases, things like that, and you have $2, $3, $4 million of debt on there, that's not going with the business post-closing. And so it may be advantageous to think about it not being the right time to sell, because you want to pay down that debt on the machine you just purchased or the line of credit, and actually recognize and realize that extra sale purchase price, as opposed to it getting paid 100% to debt. Same things for mortgages on the real estate. You just have to realize that 9 times out of 10, if private equity or most buyers are buying a business and they're assuming the real estate, they're going to want that real estate mortgage free. If you just bought the building, the mortgage is going to be pretty high and may not be the perfect time to sell, but just a consideration. Oftentimes in private equity, you're going to see rollover or a contribution and exchange agreement, which says, because we're not operators, we want you involved in the business. So we're only going to buy 60, 70, 80, 90% of it, and you're going to roll over interest post-closing. We every time do our darndest, because it's crucial to have that to be a tax-free exchange, meaning if your business is sold for 10 million and they want you to roll $1 million into the business post-closing, well, you don't want to get taxed on that $1 million that you're not actually receiving at closing. You want that to be rolled over tax-free. And depending on the entity classification and your tax status, we may have to do some pre-transaction restructuring to ensure that you have a partnership at the bottom and a lot of different tiers that the private equity might put in, so that your rollover investment is not taxed at closing. It continues on to grow tax-free. Associated with that, continued appreciation does come at a cost. You're not going to have control of the business post-closing, and there's no guarantee that the business is going to sort of appreciate. You'll be an owner, but you may not be an operator. We've had situations where really valuable employees and owners sell their business. They're the president and CEO the next day, and private equity or a new president and CEO comes in and terminates them because they want to grow their EBITDA and they don't want to have him meddling. Well, now you don't have the ability to help the business grow because they fired you, and you're just kind of waiting in the wings to hopefully have a appreciation of the business in the next 3 to 5 years when they're looking to sell again. Obviously, a benefit of rollover is that your interests are aligned with the buyer. The buyer is certainly trying to sell at a higher price than they purchased it for. So it's always good to have that working in the same direction as the buyer. The other question is, as you're leading up to a transaction, is what type of role do you really want? Is it, a lot of times we'll see people say that if they're rolling over equity, they don't want to be involved in the day-to-day, but they do need some type of advisory or board role where they are made aware of material items and can pay attention to business from at least a 20,000-foot view. Crucial to the post-closing without rollover is, are you entering into an employment or independent contractor agreement? What is your sort of exit strategy as you're thinking about it? It really just depends on your own personal sort of feeling, but it is also heavily negotiated, and it's something that is ultimately all the things that are important to you have to be sort of worked through as you're thinking about it. I mean, the important thing is it's a complete change in your paradigm as an owner, because you go from being the head honcho or one of the key employees to just being an employee and being told what to do, and that's often a culture shock to every business owner who sells. And so the things you want up front, we've got to ask for, because whether it's the buyer not wanting you around, or most times it's the sellers, oh yeah, I'm going to work for another 2 or 3 years, it's going to be great. It just changes when you've sold and you're working for somebody else. Important things to think about are, I have passion projects written here. Are there things that you want accepted out from your non-compete that are important to you? Do you have side businesses that are, or do you have, quite frankly, businesses similar to the one you're selling, but are different than the asset they're buying? Sometimes we'll sell real estate portfolios, and the owner will say, look, this is the real estate portfolio you're buying. We're making it very clear that my other smaller business is something I'm going to continue. I'm going to continue selling and owning and operating these select pieces of real estate or anything else just like it. Those are important negotiations up front. And then, do you want to do this again? Do you see yourself? We have a lot of clients that sell, and then 3 to 5 years later, they say, hey, I might want to do this again. And they'll start the business all over again and run it back. There are certain ways that you need to prepare to do that. And you can always prepare to compete, you just can't compete. And there are just a number of considerations we would want to talk to if you could see yourself at 50 selling a business and wanting to start it again at 55 or 60. Another exception about that is, would you want to do this again in a different state? Maybe you have a particular skill that's useful, and your business they're buying is entirely regional or entirely state-based. There is no reason that you shouldn't be allowed to, whether it's tomorrow or 3 years later, move to Florida or move to California. That'd be a tough ask at this time of things, but to go to Florida, go to the East Coast, if you're not competing with the people that they're buying from, you should have that accepted out of any type of non-compete, or at least we would try. Thoughts on earnouts? I've seen it time and time again that it bridges the gap in value in the minds of the buyer and seller. However, any money you don't get paid at closing, assuming it's not a family business, where you have some control or some security interests, or you're very in tune to it, any money you don't get paid at closing is money that you may never get again. So whenever there's earnouts, which is a deferred payment of a portion of the purchase price contingent upon performance metrics and other objectives of the business post-closing, you have to understand it's perhaps unlikely that you'll receive those. The question that you can ask yourself about the likelihood of that is, are you going to be there to help? Do you know what the business is currently? And how will you be able to drive the achieving of those business metrics to add the value that you think the business has. We have to be very careful in negotiating and preparing for those types of things so that private equity and other buyers can be creative on adding fees to the business post-closing that just make it harder to achieve your performance metrics. So we always negotiate the costs and expenses of post-closing things that were not part of the business pre-closing. Those should not be added in reducing the value of the business, so you can make sure you hit those performance metrics. To the extent possible, we want capital gains treatment. It's not always possible, but you know, it's an important consideration when you're talking contingent payments. Going back all the way to investment banker letters, one thing that investment bankers, and it's heavily negotiated and they get offended at, is they want to receive an investment banking fee on all your potential payments at closing. So earnouts, employment agreements, consulting agreements. We typically will go back and say, no, this is a contingent payment. I have to work for this if it's an employment or consulting agreement, or I have to continue to be involved to hit these earnouts. You're not going to get paid for something that I'm working for post-closing. And if you do get paid for it, say it's on an earnout that I achieve, it's only going to be paid at the time I actually receive it, because it's all, you know, in theory and contingent on something that has to occur in the future, oftentimes through your hard work. That's it. Hope you have questions and hope you found this was helpful.
Thanks. I had a couple questions come in. What's the quickest turnaround you've seen in a sale, and what would you say is the average amount of time a sale takes from finding a buyer to completion?
Sure. Quickest time, you know, a week. You know, if it's typically that happens in two scenarios. One is buyer and seller have been talking for a really long time and they know each other and they've been dating for a long time, and maybe they broke up and they're getting back together. You know, that type of scenario. The other one is, you know, fire sales can happen at any time. For a traditional sale, you know, it's traditional, doing everything the right way. 30 days is very, very, very fast. But we've seen fire sales happen with pretty good businesses, you know, in a week's time. What happens there is you basically you draft a term sheet and a side letter and say, we're paying and exchanging dollars in business, and we covenant and agree to work all the hard stuff out after the fact. That's how you make it happen. You have a lot of faith and trust, and it's a tough process post-closing. But average transaction time, you know, in the 2 to 20 million range, you're looking at 3 to 6 months. You know, and then the larger transactions are such a variety. You may have an army of counsel that is on it, and we're on there. You know, it depends. It's very, very. It varies because it's what type of consents or approvals you have, that type of thing.
Okay. Along the sales line, there was another question that came in. What's the worst thing you've ever seen in a sale?
The worst thing. I've told this story before, but I mean, and it's really COVID related. I can tell you just disaster sales. So, and they were great for our clients. So we had two sellers. One was was the largest sort of event planner in the United States for colleges. So it was 2019, and if there's a big college game and you know you're moving you know 50,000 fans for this big bowl game or a big tournament, or getting people in for the NCAA Final Four, that type of thing, or they sold that business at the end of 2019. Obviously, the buyer had a business in 2019 that was entirely predicated on hundreds of thousands of people getting really close together and you know, breathing on each other and screaming on each other. So that was a that was a pretty bad situation for the buyer and a great situation for the seller. Another crazy one was similarly in 2019, we sold a business that did nothing but study abroad programs in Europe and Australia. And so we sold that business in 2019, and obviously in 2020, we saw a buyer that was completely bankrupt because they had no one was traveling to Europe and Australia for, the better part of 2 years now. Those are pretty bad. I don't know if I've seen any other. 95 to 98% of businesses are go smoothly. The transactions work smoothly, and there aren't many disasters. I think you see disasters more on bad luck or buying a business without an infrastructure. The personalities don't jive, and emotion gets involved, and they terminate somebody who's really crucial to running things, or that really crucial person who's running things doesn't want to work anymore post closing and leaves. But 95 or greater percent of the transactions are successful without too many disasters.
That's good. A question, what's the trend you're seeing regarding ESOPs in terms of the number of deals you're seeing over the last 5 years and the percent of deals that you've been doing?
Yeah, so ESOPs have always been a thing. I hadn't done many of them until the last 3 years, and they are absolutely growing. And an ESOP's obviously a way for a seller to sell without really a buyer, right? The buyer is just employees of the business. Valuations are high right now. It's a way to exit without having to find that independent third party. So the question with the ESOP is, do you go find an investment banker who may be able to maximize value and make a really smooth transition, or do you just know someone? You don't need an investment banker to sell your business to your own employees. You just need a good consultant, an accountant to help you do that. But we've done a handful each year, and material transactions with the ESOP in the ESOP space. We've got a couple in the hopper right now that are going through diligence phase, because there's such a high valuation and interest rates are so low for borrowing money. The trend is high, and a lot of folks are doing them, and they're a great way to recognize value for the sellers.
Yeah, I think Austin's making the point that the problem with ESOPs almost always is the valuation, and with valuations high, it's making it more likely now. You have, when you're selling to an ESOP, you have, unlike a third-party seller, you have fiduciary obligations that sort of creep in, and you need to get third-party valuations. And what has always been sort of the hurdle to getting a deal done is, well, the owner's thinking, well, I ought to get 15 million or 20 million, and then that isn't supported by the third-party valuation. Now, with valuations being high and demand being so high, people are finding that to be a little bit easier to do to get what they want to get out of the company. And I'd also note, I don't know if it was said at the last presentation that you had on this topic, where they did talk a little bit about ESOPs as a buyer. If a owner sells at least 30% of the equity to an ESOP, there's an opportunity to take the proceeds from that sale and roll that over in a tax-free rollover to marketable equities. And that's a big attractive feature for some owners to take some risk off the table, where they're basically financing their buyout in chunks and allowing them to put some of their assets as they approach retirement into the stock market. And it works particularly well for businesses around Northwest Ohio. We might have a machine shop in Bryan or a manufacturing plant in Norwalk, where the buyer might be looking to buy the customers and shut down that factory or machine shop because they just don't want a business in the suburbs of Northwest Ohio. And some owners feel a good amount of obligation of, I've got a good business, it will run in Gibsonburg for as long as we care to do it. If we sell, we're basically terminating that business in Gibsonburg, and they want it to continue for a variety of reasons, including pride.
Okay, thanks. I'm going to combine a couple of these questions together. I think they go together. What's the one thing that you would recommend to the seller to make the sale of the business easier? And then overall, is there any advice you'd like to share with family businesses in particular, or problems or issues that are unique to family businesses?
The one thing that makes things easier is really understanding your contracts and your diligence. There's always someone that can help you with your financials, get those in order. You probably understand them anyways. And like I said, a buyer will just look at them and say, do I want the business or not? Regardless of whether or not your financials are exactly GAAP. You may have bodies buried in litigation or debts. Those are just things you know of and deal with. But to make a situation easier is understanding what consents and approvals are required for selling your business. What is the relationship with your customers and suppliers? And ensuring that if you Google due diligence request list, that you're organized and able to respond to what I would call a standard due diligence request list, meaning a request for information materials from the buyer to the seller so that they can properly evaluate the business and ensure that they have comfort in closing on a transaction. The reason we don't have many pitfalls or bad situations in a sale is because we have a pretty broad team of specialists that dive into every one of the aspects of your business and ensure that we've uncovered every wart. Maybe we tell the buyer about it, maybe we don't, but we've uncovered all the problems prior to signing a deal. The more organized you are in each aspect of your business, the easier it's going to be on you. And, quite frankly, the lower the fee you're going to be paying your lawyers and advisors. Was there another question?
Okay, just any general advice that you would have to family businesses or problems or issues that you're seeing that are unique to family businesses that they should be aware of that's maybe trending now?
Yeah, I mean, I think that I think we're going to see valuations potentially lower again. We are seeing buyers sort of, that's a pretty frothy market. I think I would probably ensure that your debt arrangements are shored up for the long period of time. We're seeing sort of lines of credit. Folks are inclined to, banks are getting a little stickier with their lending arrangements. So if you need ongoing function in that area, I would consider locking that in now. I think Scott brought up a good point about understanding your benefits and your long-term incentives and your arrangements there. That's important. But again, organization is very, very critical. And the more you're organized, understanding where your contracts are, what your terms and conditions say for purchase or sale. A lot of times you're just entering into purchase orders on the buying and selling of products, and you don't know that each one of those has a different set of terms and conditions. Kind of sort of making those sort of more universal would be very helpful, particularly if you're considering selling.
I would just say I've seen two unique family business situations that I've dealt with, and it really is communication between the parents and the children, and expectations of is the business going to continue? Is the child going to inherit? We had one situation where the daughter was effectively the CEO for many years. The father determined he was going to sell the business. Daughter is a key employee and not a stockholder because she's just expecting to buy it from him someday. And he goes to sell it and is then surprised that she's not going to just continue along working for her salary with no expectation of ownership. And so she leaves. She very, very in-demand executive and basically said, no, I don't want to, if I'm going to work for somebody, I'm going to get paid my market value. I've been taking a discount for years with the expectation I'll be the owner. And that was basically took a big chunk of the value off and created quite a bit of family drama of, well, hey, you're costing me millions of dollars. And the daughter's response was, yeah, same. And the transaction went through, but a very, very large discount. And then another situation is the child was running the business and similarly was expecting to buy, wasn't offered the opportunity, and went and started a competing business. No employment agreement, no non-compete. So that's happened. Both of those happened right before COVID, and I haven't followed up to find out what, if any, developments happened after that. So I would say communication is key of expectations.
Great. Well, thanks for sharing. I know how many headaches could be solved or avoided just by proper communication or over communicating. So thank you both to Scott and Austin for joining us today. As always, you provided a ton of great content. As a reminder to the group, we did record the session. We will send the link out once it is posted on our YouTube page. Feel free to share that with anyone that you think could use this information, with a colleague, with a friend. Our next mini forum is May 17th. It'll wrap up our series in selling your business. It'll be Skylight Financial Group. They're going to be sharing some case studies and diving deeper into buy-sell agreements, including best practices and how to finance them. Again, that will be 10 a.m. on May 17th. If you'd like registered for that, if you haven't seen that invitation, just send me, Megan, Kirsten, an email and we will get you registered for that and send you the Zoom link. And Kirsten in the chat put links to all of our social media. We'd love for you to like, comment, share. Megan does a great job at getting content out on there. So thank you everyone for joining us and enjoy the rest of your day.
Thanks everybody.